Why are firms diversifying their supply chains from China? For decades, China has been the factory of the world, providing US and international firms the ability to produce products cheaper than domestic production would allow. In 2019, total trade between the United States and China totaled an immense $634.8 billion. While recent sanctions and the ongoing coronavirus pandemic have slightly reduced overall trade, it is still, depending on the month, the largest overall trading partner with the United States. As of US Census data from September of 2020, China and Mexico are neck and neck for the top trading partner spot with the United States, with less than $1 billion difference between them. However, 2020 finds numerous companies planning to diversify production beyond solely relying on China. So why are companies deciding to look at countries outside of China for production capacity? Well, first, let's take a quick look at the rise of China as a major manufacturing power. The rise of China. Prior to the 1980s, very few international goods were actually made in China. However, the Chinese president at the time felt that China needed to redefine its economic system and institute what was arguably a market-based system while also creating industrial zones. The lower costs of Chinese labor and the simply immense number of Chinese people searching for work helped to push China to the forefront of manufacturing over the next few decades. Over this time, China's infrastructure evolved with the manufacturing demand. Now, China has the ecosystem and assets in place to produce nearly anything quite efficiently. The city of Shenzhen, in particular, has become a major hub of electronics manufacturing. While many will critique China's currency valuations through the years, it has to be said that a lower valued currency does promote exports as it makes purchasing goods cheaper relative to another nation. China has a highly advanced manufacturing industry that can create highly precise and complicated automotive, aerospace, medical, and electronics components and products. For examples of this, just look at Apple's huge Chinese manufacturing investment and the investment that Tesla is currently making to build a factory in China. So why would companies shift manufacturing from China? Over the last few years, many firms have started to realize that China isn't quite as cheap as it once was from a labor and cost perspective to manufacture goods. That, tied with an at times turbulent political relationship, ongoing tariffs and trade disputes, and then currently the COVID-19 pandemic, have made firms question their heavy reliance on China as a near sole source of many parts and goods. COVID-19 in particular was a stress test for many supply chains. With China's factories shutting down well before the rest of the world was hit with the brunt of the pandemic, companies ranging from small businesses to global leaders like Mazda and Apple have been hit hard by COVID-related factory shutdowns that have caused part and product shortages. This has pushed these firms to think long and hard about relying on a single country as a sole source of production. Mazda, for example, had to immediately turn to factories in Mexico to build certain sub-assemblies that were then headed to Japan to keep their Mazda 3 and CX-30 factory running. Tariffs have also been an ongoing source of frustration for many US firms buying Chinese goods and materials. While the effectiveness of tariffs is questionable, they have nonetheless been implemented on many types of imports. Tariffs currently range between 7.5% and 25% on many US imports from China. As of late 2020, these tariffs have totaled nearly $80 billion, which is a substantial sum of money on a vital trade artery. What to expect over the next decade? It's impossible to predict exactly what will happen over the next 3 to 10 years, with the recent presidential election potentially also affecting the levels of tariffs as we enter 2021. However, even if we assume tariffs will decrease, supply chain resiliency and diversification has become a major focus primarily due to COVID-19. As US firms start to plan their capital budgets going forward, it is very likely that they will prefer to diversify their production base and not solely rely on a single source of production, in this case, oftentimes Chinese factories. There have been reports that firms such as Microsoft, Amazon, HP, Dell, and Sony are looking for ways to diversify production outside of China. Countries such as Mexico, India, Vietnam, Bangladesh, and Taiwan will experience a rise in industrial development and investment from foreign firms and will do everything they can to promote it. Mexico, in particular, for many US firms, presents an interesting mix of benefits, including much easier oversight due to its close proximity to the United States, reduced transportation cost, since trains, including intermodal trains and trucks, can be used in place of ships and planes, quicker lead time, favorable trade agreements, and a favorable political situation. The signing of the recent USMCA agreement also is indicative of many companies looking more seriously at utilizing nearshore opportunities such as Mexico or Canada as a source of factory capacity going forward. Many US manufacturing and logistics experts are predicting a large rise in the amount of cross-border freight and US firms' manufacturing presence within Mexico. Several North American railroads are even starting to invest in additional cross-border Mexico freight capacity to capture future volume increases. Conclusion: China will remain a major, if not the top, US trading partner for decades to come. However, in an attempt to build more resilient supply chains that are not so heavily reliant on one country, firms will start to diversify to several other potential countries for some of their manufacturing capacity. More videos are coming along from Zmodal very soon. Subscribe and like!